I had to break the rules. Every $5,000 increment, I make a portfolio update. Now, the last portfolio update was a little over 4 months ago. So I guess it's time to see what changed and how the portfolio is doing. Before jumping into the video, hello everyone, my name is Dividend Dashboard, and in this YouTube channel, we talk about stock analysis where we do discounted cash flow, look at margins, and SWOT analysis. We also talk about my dividend investing journey where we do portfolio updates in full transparency and showing you the data in a different way rather than straight up from the brokerage account. So if you want to follow along, hit that subscribe button, it's free and it helps the channel out. So starting out with the portfolio value is currently sitting at $12,994.56 with $268 in buying power. Projected annual dividend is $431.59, which translates to a dividend yield of 3.68%. I currently have 21 holdings in this portfolio. Compared to the market, the portfolio is not performing that well. Later on, we will go through the holdings that are slowing down the portfolio and capital appreciation. We can see that in every single time period, the market is beating us. The current market gains are driven by big tech, which accounts for 30% of the S&P 500. Now, like they say, the bigger they are, the harder they fall. So if a pullback happens to big tech, the gap in performance between my portfolio and the market could close. Looking at how my portfolio is diversified by sector. For those who have been following me, consumer defensive is my favorite. Not the best in growth, but it performs pretty well in every market condition, usually making it predictable. The companies in this sector usually have the power to increase prices and have their margins expanded. Overall, I like the diversification here, and as the portfolio matures, changes could occur. I have 21 holdings in my portfolio. I consistently add small tranches every week to those holdings. I believe they're undervalued or simply just dollar cost average into them. I have companies that I haven't bought for a while because they have stretched in valuations. For example, I haven't purchased anything in Coca-Cola for almost 2 years. It just keeps going up in value and it's out of my price target. This results in the allocation to be so minuscule at 1.70%. The same goes for Apple, but that's a different story. Apple did a stock split, has appreciated heavily in price, and that's my only holding with drip. So even though I have not purchased anything in Apple, it still goes up. I do like how the portfolio looks. Every stock has a purpose. Some are compounding core holdings, others are for income. There are several high-quality businesses on my watch list that I would like to add in the future. The latest addition to this portfolio is Hershey, and I'm planning to do a stock analysis video to cover this high-quality compounding company. Looking at the annual dividend per holding, the massive dividend that AT&T provides clearly catches an eye. AT&T is one of my income-based stocks in my portfolio that I might plan to sell within 5 years. It all comes down to the roadmap of my investing strategy. Anyways, at least 95% of the companies in my portfolio are dividend growers. These are companies that have increased their dividend every year. The combination of increased dividends, contributions, and share buybacks has led this portfolio to continuously increase. The AT&T dividend makes the other holding dividends look small, but when you look at 3M, DLR, Starbucks, Realty Income, and J&J, then you see that they are bringing decent cash flow. Average cost versus capital gain or loss. In blue, we have the average cost of my holdings, and in gray, we have the gain or loss if I were to sell the position. Let's talk about the holdings that are down and responsible for the poor performance of my portfolio versus the benchmark. Let's start with Realty Income. Just the nature of the business, real estate. Brick and mortar retail businesses are cyclical. Simply, people are moving to safer investments, but overall nothing alarming with realty. The rents keeps coming in for this company. AT&T. Let's keep it simple with this stock. Huge capital expenditure, piles of debt, low ROCE, and intense competition where no moat can be declared. The stock has been in a downtrend due to mismanagement, and since this spinoff, the stock took additional sell pressure due to the dividend adjustment. 3M. Lawsuits. Without the settlement of lawsuits, we cannot calculate the fair value of the company, bringing high uncertainty and selling pressure. J&J. They got a settlement for their lawsuit, and the spinoff could happen later this year. This is being priced in. AbbVie. The Humira patent expiry estimates a loss in revenue for the company. Even having Rinvoq and Skyrizi bring in decent numbers, Humira is a big component of their revenue. We will need to see how it battles generic brands. I believe all of the companies mentioned will be okay in the future. Some will likely do better than others, and not all of them have the same purpose in my portfolio. So let's see how it goes. From another perspective, let's see the total return. Percentage-wise, the losers in my portfolio are holding some gains, but we do have more winners than losers. If it wasn't for Apple, I would have been in a worse position right now. Even though I'm diversified through 21 companies, Apple seemed to be the backbone of the gains, making my other big winners like KO, Starbucks, Stag, and JP Morgan to look very small. Overall, I'll continue with the weekly deposits, reinvesting dividends, and continue to learn as an investor. So that will be it for this portfolio update. Thanks for watching, subscribe for more episodes, and I'll see you in the next one.